Happy Friday, everybody. It's Shayan with Integrity Home Mortgage, back with your weekly mortgage market commentary. You wouldn't know it from the lack of significant movement in rates markets this week, but this was actually one of the most consequential weeks for treasuries and for mortgages. The data that we received, or perhaps more appropriately, the lack of significant surprises in the data that we received, has most market participants viewing the upcoming Fed announcement as more or less a formality for a foregone conclusion. Let's, before we get into that, start by jumping into this week's data. Really the three most consequential reports this week, which were Producer Price Index, Consumer Price Index, and jobless claims. So PPI came in low, showing an unexpected decline of 0.1% month over month. And so this is probably indicating that perhaps inflation pressures are easing further up in the supply chain. Manufacturers maybe are absorbing some of the costs related to tariffs rather than passing them on to wholesalers. Consumer Price Index showed a little bit more of a mixed picture. The headline inflation rate rose to 2.9% year over year, but this was primarily driven by the passing through of inflation costs onto consumer goods. While that definitely sucks for us consumers, this is a fact that the Fed has already signaled that it views as temporary and not persistent. Core CPI, which excludes volatile food and energy costs, remains stable at 3.1% year over year. Now that's still well above the Fed's 2% target, but at least it's not going up. Finally, we had jobless claims. This data point is one that I think got a little bit less than appropriate share of coverage this week. Markets rallied on the same day that we got that less than encouraging CPI report, and I think that had a lot to do with the fact that jobless claims hit their highest level in almost 4 years. Remember, last week we talked about the fact that the Fed's focus is now more on jobs than it is on inflation, and I think this is the markets kind of holding to that narrative. So before we get into our look ahead to next week, let's just take a quick minute to reflect on where we've been and where we've gotten to over the past 8 weeks. So over the past 8 weeks, 10-year Treasury yields have dropped a whopping 50 basis points, right? Going from 4.5% to as low as 3.99% yesterday, and currently sitting right around 4.06. Mortgage prices have rallied over 200 basis points, pushing the average 30-year fixed-rate mortgage rate down 40 basis points to the lowest we've seen in about a year. So that now those can be had for somewhere in the mid to low sixes now. None of this, bear in mind, has anything to do with the Fed actually cutting rates, right? The Fed is still on hold and has been for some time. This is because the prevailing market view on rate cuts went from if to when, and from when to now. So it is the expectation around what the Fed will do and not what the Fed is actually doing. So let's look ahead to next week. There's some data on the calendar, but nothing really matters other than the Fed. Inflation continues to run hot and continues to really trend in the wrong direction. But the mixed nature of this week's inflation data, combined with further confirmation on weakening labor markets, means markets are basically betting that it's not enough to dissuade the Fed from cutting, and thus the foregone conclusion that I was talking about earlier. There's basically a 100% chance that we get a 25 basis point cut to Fed funds rate, but we will also get a fresh batch of dot plots, which are the series of projections from FOMC members on what each of them view as the likely path of interest rates and inflation and really economic growth going forward. With the change in policy and a new set of forecasts, Chair Powell's press conference is sure to be an interesting one, and one that will be very highly scrutinized. The markets will not react to a 25 basis point cut. That's been baked in for weeks now. They could, however, react to the dot plots and or Powell's comments if they come across as either too dovish or not dovish enough. So in there somewhere, there's like a needle that needs to be thread, where they affirm the market's expectations of a series of programmatic cuts, without coming across as panicked about a recession. So this week's bottom line is mortgage rates hit a new low for the year. This is a positive for home affordability, and this also means that a solid chunk of people who got their mortgage since, call it, February of 2023 could realize a significant benefit from refinancing today. So there's opportunity in refinance mortgages. And the Fed announcement is next week, and that is the overwhelmingly dominant headline for the week. Markets should remain stuck in this current range until that time, but all bets are off after 2 p.m. on Wednesday. The Fed does not want to surprise the market. It's been a fairly orderly move over the past 8 weeks, and they'd like to see that continue, but it is undeniably tough to thread a needle while the whole world is watching. That's all I got for this week. Have a great week, and we will see you next Friday.